Well, good morning, Jaginder Rana here. Topic for our discussion today is bank deposit insurance. Bank deposit insurance. In a major relief for term and saving account depositors in banks, the Reserve Bank of India is reportedly mulling raising the deposit insurance limits from the present level of rupees 5 lakh. The decision on raising this insurance limit provided by the Deposit Insurance and Credit Guarantee Corporation under the RBI is expected to be taken soon. So the DICGC insurers, all insures, DICGC means the Deposit Insurance and Credit Guarantee Corporation insures all deposits such as savings, fixed, current, recurring and more up to a maximum of rupees 5 lakh. So for both principal and interest amount held by customers with commercial and cooperative banks. Now the deposit caps in different branches of a bank are aggregated for the purpose of insurance cover and a maximum amount of up to rupees 5 lakh is paid. However, if the funds are in different types of ownership or are deposited into separate banks, they would then be separately insured. Imagine that you have deposited all your life's earnings in a bank. You are old and retired, and your only source of income is the money deposited in the banks. And one day the news comes that the bank in which you have deposited the money have gone bankrupt. So the panic that you will have in such situation can only be left by someone or can be felt by someone who has gone through this phase. In such situation, depositors get a ray of hope. DICGC, that is Deposit Insurance and Credit Guarantee Corporation, which provides insurance on deposits in banks, but this insurance is limited to rupees 5 lakh and this limit is now under question. So what is the DICGC and why is it necessary? DICGC's purpose is that if the bank closes down or goes bankrupt, the depositors can get back their deposit amount currently up to the maximum of rupees 5 lakh. So, during the budget session this year, it was discussed that any decision in this regard will be taken considering the financial position of the DICGC and the entire banking system. The Finance Minister was asked by members if the government was planning to increase the deposit insurance limit to rupees 50 lakh under the DICGC. The question is, why is it necessary to increase the insurance limit for deposit in banks? The reason is, first one, PMC bank crisis. In 2019, when the RBI imposed restrictions on Punjab and Maharashtra Cooperative Bank, many depositors got upset. Some of them had deposits worth lakhs of rupees, but they only got insurance protection of rupees 5 lakh. Then there was Yes Bank case. During the Yes Bank crisis, even though the government and RBI handled the situation, if this had not happened, a large amount of customers would have been in danger. Then the Lakshmi Sahakari Bank and other local cooperative banks. There have been many cases of small cooperative banks collapsing where customers had to struggle for their money for years. So why is it necessary to increase the limit? Because rupees 5 lakh is insufficient in the era of inflation and high deposits. And today's time the FD of a common middle class family is above rupees 10 lakh. In such a situation, the limit of rupees 5 lakh does not cause relief but fear. Moreover, the security to rural and elderly depositors is required. The elderly And people of small towns are most dependent on banks. For them, the deposit amount is a lifetime income. Then the government increases the insurance limit. It sends a message that your money is safe, and this is also strengthens people's trust in the banking system. So if the limit is increased to rupees 10 lakh or rupees 15 lakh, most ordinary depositors will be fully covered. Customers' fear of cooperatives banks will be reduced. Insurance premium cost of banks will increase, but customers' safety is paramount. So this is necessary and timely steps to protect customers in the banking sector. The incidents of PMC and other banks have made it clear that limited insurance cover is not enough for the financial security of people. So if the government increases this insurance limit, it will act as a safety net for millions of customers and prove that the government gives priority to public interest. Bank deposit insurance is a foundational safety net designed to protect the depositors, the primary providers of capital to banks. It plays a crucial role in maintaining public trust and ensuring financial stability, particularly during banking crises. While the concept of deposit insurance is reassuring in theory, the practical implementation in India often falls short, leaving key gaps in depositor protection. So, the evolution of India's deposit insurance framework, considering its limitations and whether recent policy measures are genuinely proactive or simply reactive responses to emerging risks. India was the second country in the world after the US to introduce doing so in 1962. So the Deposit Insurance and the Credit Guarantee Corporation, a subsidiary of the Reserve Bank of India, oversees this system. Today the insurance covers up to rupees 5 lakh per depositors per bank. According to the RBI's Handbook of Statistics on the Indian economy, 98% of deposit accounts by number were covered under this scheme in 23-24. However, in value terms, only 43% of total deposits were insured. So this discrepancy reveals two significant insights. First, a small group of depositors, roughly 2%, hold around 57% of total deposits, so far exceeding the rupees 5 lakh insurance cap. This leaves high value depositors particularly vulnerable despite their outsized contribution to a banking system. Then the second, coverage and value terms has been on the decline, falling from 50% in 2021 when the insurance limit was last raised from rupees 1 lakh to rupees 5 lakh. In effect, a critical section of depositors, those who contribute the most, remain inadequately protected. This raises an important question. Does the current philosophy of deposit insurance still serves its intended purpose? While it aims to shield depositors from financial shocks, the system falls short precisely where the stakes are highest. So in times of uncertainty, large depositors may exit en masse, potentially triggering a destabilizing bank run. A recent report by the State Bank of India shows that India's deposit insurance coverage ranks among the lowest globally. Even within the BRICS bloc, India trends coverage is roughly rupees 42 lakh in Brazil and rupees 12 lakh in Russia. So the issue is not only the adequacy of the insurance limit but also its ability to instill confidence across the depositors spectrum. Historically, increases in India's deposit insurance limits have been reactive, often following financial crises. The most recent hikes in February 2020 came in the wake of the Punjab and Maharashtra Cooperative Bank crisis. Similarly, the 1993 revision from rupees 30,000 to rupees 1 lakh followed the collapse of the Bank of Karat. So the urgency of rethinking deposit insurance is underscored by a shift in household saving behaviors. Between 2021 and 2024, deposits grew from 28% to 41% of total household financial assets. So despite the rise of alternative investment advantages like equities and mutual funds, this trend reinforces the centrality of bank deposits in India's financial ecosystem and highlights while strengthening deposit protection is critical. So far, changes to insurance limits have aimed to calm public anxiety and restore confidence. But the RBI's reported deliberations over another potential increase raise a new set of questions. Is this an effort to attract deposits in a competitive financial landscape, a response to the collapse of the New India cooperative banks, or a genuinely forward-looking move to account for rising saving and systematic risk? So while raising the insurance cap can boost depositors' confidence, it also brings the risk of moral hazard, where both banks and depositors may take on greater risk under the assumption of a safety net. The depositors might pay less attention to a bank's financial health, and banks might be tempted to pursue riskier lending or investment strategies. Ultimately, deposit insurance should be more than just a backstop against future or backstop against failure. So it should be a robust, well-calibrated mechanism that reinforces trust across the banking system. Policymakers must decide whether to merely patch existing flaws or to rethink the very philosophy underpinning India's deposit insurance rhythm. Because now the system is continuing, but the limit is the old one, and that limit is not sufficient. So the question is rising again and again, what should be the limit? Because think of deposit insurance as a safety net for your savings. In India, if your bank shuts down for some reason, you are guaranteed to get back rupees 5 lakh from your deposits in that bank. It applies per person, per bank. So if you have accounts in two different banks, each one is insured up to rupees 5 lakh. It's a basic layer of protection that gives people some peace of mind. It covers savings, fixed, current and recurring deposits. So it is important to remember that both the principal amount and the accrued interest are covered under insurance. A while ago, the finance minister hinted that an increase in deposit insurance was under consideration. So with the prior approval of the government, the Deposit Insurance and Credit Guarantee Corporation raised the deposit insurance coverage limit from rupees 1 lakh to 5 lakh with effect from April 4, 2020. Now rupees 5 lakh is not what it used to be. These days a lot of people keep more than that in their savings or fixed deposit accounts, especially retirees or individuals saving for big goals. So anything above rupees 5 lakh is not covered if a bank fails, which can be a real worry. So there is a growing feeling that the insurance limit should be increased to match the way people save now. Thank you very much.